Okay, so in this lecture, I would like to show you and teach you what is liquidity, what's my approach to liquidity, and how liquidity works in market, and how you can use liquidity as a sign for potential buy or for potential sell. So, the definition and key takeaways of liquidity. Liquidity refers to the ease with which an asset or security can be converted into ready cash without affecting its market price. So if you studied the previous lecture market mechanics, you will understand this concept and this theory as well. Because liquidity is nothing more than just balance in the market. Liquid levels are levels where there's enough buyers for enough sellers, and enough sellers for enough buyers. So let's get back to apples. Let's say you want to sell 10,000 of apples, and at the level where you want to sell those apples are buyers which are willing to buy only, for example, 6,000 of those apples. Therefore, for you, there's not enough liquidity, and your sell price will be averaged at lower levels, which means lower profit for you. However, if you want to sell 10,000 of apples at specific price level, and there's enough buyers who are willing to buy, for example, 10,000 of apples, there's enough liquidity, so price has no reason to move up or down. Because you sell 10,000 of apples for specific price, which is okay for the counter side, which in this case are buyers. So you agree with buyers on one price level, so there's enough liquidity and price has no reason to move up or down. And now, how liquidity works in live markets, because that's not like that easy as it looks like. You often heard that liquidity is key, and for example in smart money concepts, theories, there are a ton of liquidity levels, you need to wait for liquidity sweeps, etc. And now, why it's important to wait for liquidity sweeps? Liquidity sweeps can show you if big player enters the market, because if you're a big player, you need big liquidity, and big players moves the market. And now, how big players use liquidity for their advantage? First of all, liquidity is created by passive participants, so passive buyer or passive seller. So in short, limit orders. When you open, for example, short position as an aggressive participant for market price, you have stop loss and take profit level. And stop loss and take profit levels are passive limit orders, because whenever price reach those levels, it will mitigate your position either in profit or in disprofit. And with this, here comes another very important thing to know. When you are in short position, your stop loss and take profit levels are passive buy orders. When you are in long position, your stop loss and take profit levels are passive sell orders. So when you want to mitigate long position, you need to hit either market sell or set limit sell orders. And if you are in a short position and you want to mitigate this position, you need to set limit buy orders or hit market buy to close this position. For us, it's important those limit orders, stop loss and take profit levels, because those levels are liquidity levels. Levels where are a lot of passive sell or buy orders. So in live action, if you want to sell again 10,000 of apples for $5 and at price level of $5 are, for example, buyers which are willing to buy only 6,000 of those apples, but you still don't want your price to be averaged at lower price levels, you simply wait until traders open their short positions. And as soon as enough short positions are accumulated at this level, each short position has its own stop loss level. And stop loss level for short position is buy, limit buy, because it will mitigate short position. And those stop loss levels of those short traders are levels where will be sold the rest of your apples. So as a result, your sell price will be not averaged at lower price levels, therefore your profit will be higher. And that's why a lot of those aggressive down moves or up moves happens after some liquidity sweeps. So that's the principle of liquidity and how it works. Unfortunately, the most difficult thing is to find those levels where is liquidity. The most used liquidity levels are previous swing lows or swing highs, and range highs and range lows. And usually those sweeps are aggressive. So whenever you see sharp move to the upside or downside above range or below range, or above swing high or below swing low with decent volume spike, it means that okay, at this level there is a lot of interest in trading, and it can symbolize the sweep of liquidity. And you can tell it if it's sweep of liquidity or not by looking at order flow, especially at what is called price versus participants. If price respect this level and accept it, or if it's rejected. And this is topic for next lecture.